than 2 trillion euros in outstanding loans, banks remain, according to the Banque de France, the main providers of credit in 2021. Given the amounts at stake, they place an emphasis on the borrower's ability to meet their debt obligations at the center of their concerns. The goal is indeed to reduce the cost of risk and to maintain the highest possible quality credit portfolio. Commitment, the contract, through which the client acknowledges their debt and commits to repaying it, from their perspective, leaves very little room for risk-taking. They specify the debtor's repayment schedule, as well as the mutual rights and obligations of both parties. Over time, banks have become experts in managing these commitments by mobilizing what Berger and Udell in 2006 call a combination of financing technologies. These include information gathering, policies and procedures for processing applications, the structure of loan contracts, credit scores, collateral, and the management of debt throughout the entire financing lifecycle up to the extinction of the debt. The nature of the contracts fits more broadly within the credit policy of the institution. From one bank to another, the combination of technologies can lead to more or less restrictive commitments for the client. At the organizational level, the activity is constrained by prudential and regulatory requirements. These play a key role because they require banks to maintain levels of provisions and capital reserves aimed at anticipating the occurrence of payment defaults. At the operational level, while choosing the most suitable contract, may depend on the asset being financed or the borrower's profile. The banks' and advisors' profiles also impact the nature of the commitment. The judgment of the parties involved in the decision-making process remains crucial. The account manager or business advisor, as the first point of contact responsible for gathering information, will seek to detect any signs that could indicate a potential risk of default. While this flexibility allows the bank's decision to be closely tailored, it can also lead to unsuccessful judgments. Despite the numerous procedures and structures put in place to guide decisions as precisely as possible, certain signals can be misinterpreted by the banker and lead to decision-making biases. This can happen, for example, when there is an overreaction to a signal such as gender or ethnic origin of the borrower, or in the case of an entrepreneur facing difficulties or who has already experienced bankruptcy. Such decisions can then lead to lost opportunities for both the bank and the client.